Alright, so what the fuck did Enron actually do? Off the top of your head, you are probably saying something about creative accounting, corporate fraud, or, if you are really clever, maybe even terms like mark-to-market. But what did all of this really mean? And perhaps more importantly, would it be considered that bad by today's standards? The headline story that you are probably familiar with is that the business started out as a moderately successful energy company, but when compounding profits became harder and harder to come by, they resorted to progressively more and more desperate fraudulent activities to keep the party going as long as they could. They had convinced the world that they were the smartest men in the room. They made impressive but willfully reckless projections about their future performance. They created complex deal networks to make revenue look far better than it actually was, and they hid their expenses creatively, all so they could cash out their shares and make themselves generationally wealthy. And oh wait, hold on. Hang on, guys. Sorry, that's the wrong VCR. Let me just fix that up real quick. Okay, there we go. The reality is that today, Enron is synonymous with corporate greed and corruption. More than 2 decades on, it has radically reshaped the way business is conducted. But in the years since, there have been plenty of larger and more brazen examples of outright fraud, many of which went largely unpunished and unremembered. If you actually go back and understand the story about how this company grew so quickly and self-destructed so spectacularly, you might just see some concerning trends emerging in the same markets today. We learned a lot from Enron, but they may not have been the right lessons.
The collapse of the deal between Enron and Dynegy has left Enron employees stunned, many of them wondering if they'll be getting their next paycheck.
8 counts of fraud and conspiracy.
Lawyers for Jeffrey Skilling and Kenneth Lay threw around complicated notions about margin calls and short selling.
A few years ago, Enron was the nation's 7th largest corporation, valued at almost $70 billion. Pundits praised the company as a new business model.
Guilty verdicts in the biggest case of corporate fraud in history.
Okay, so as always, I put the question to you. What was Enron? If you are brave enough, then leave your answer in the comments now. If you can believe it, the company wasn't founded with the express intention of becoming a massive fraud. And for a while there, it was really just a boring old business in a boring old industry. Ironically, the story actually starts in Omaha, Nebraska, with the Northern Natural Gas Company. Since the 1930s, this business had been supplying natural gas as a cheap source of fuel to industry and households across the northern US states. Over time, it acquired several other energy companies, as well as a handful of natural resource exploration businesses, energy networks, and a business that sold propane and propane accessories. As these acquisitions grew, the company rebranded to InterNorth as a holding company for these various operations. The company did well by growing and swallowing as many competitors as it could, but this risky business strategy eventually got company management into some trouble. In the late 1970s, the natural gas industry was deregulated. The government would no longer guarantee prices for this resource. This radically shook up what was, at the time, a very conservative business. InterNorth's long track record of swallowing up lots of other operations also made them bloated and unable to adapt quickly to the changing market conditions, which put them in the crosshairs of corporate raiders. To make matters worse, they didn't really change up their strategy. In 1983, they made their biggest acquisition to date, the Belco Petroleum Company, which was a Fortune 500 business and almost larger than InterNorth itself. This created a serious problem for the business. Bear with my analogy for the moment, but it was a bit like that time my Pomeranian ate an entire porterhouse steak that I had left unattended on the kitchen table. From the outside, he was still technically a dog, but by body weight, he was majority cow. Either way, if he had to fend for himself in the wild, then to a potential hungry predator, he was a tasty meal on top of another tasty meal. And that was exactly the situation InterNorth found itself in by 1985. Activist investors were buying up its stock with the plan to take control of the company and then sell off all the parts it had acquired over the years at a profit, before running what was left as an overall leaner operation. Hostile takeovers like this had become very common by the 1980s, so much so that they were a central plot point in the original Wall Street movie. The reason it was so ironic to have InterNorth headquartered in Omaha, Nebraska, is that down the road from their office, just 5 minutes away, was the new head office of Berkshire Hathaway. For a few years, two of the most infamous businesses in American corporate history could see each other out of their window in an otherwise very low-key city. Of course, they both became famous for very different reasons. Buffett's Berkshire Hathaway is now held up as a shining example of a slow, steady, considered approach to business. Internorth, and its eventual successor, they made history for a, slightly different reason. But that's not the last we will be hearing about Old Man Buffett in this story, because arguably, he was one of the only winners out of this whole thing. Either way, seeing how endless acquisitions had made them a slow, lumbering target for any hostile takeover, Internorth's management did the only logical thing, and moved to make the company even bigger through even more acquisitions. In July of 1985, Internorth and Houston Natural Gas voted to merge into one company. Although this was technically a merger on paper, Internorth paid $2.3 billion to acquire HNG, which at the time was a significant premium over what the business was actually worth. Once combined, the two new companies went by the incredibly creative name HNG Internorth. Oh, truly inspired. Anyway, the idea was that by making the business so big, it would become impossible for any single investor to gain control, therefore avoiding a hostile takeover. Now, even though technically this was a merger between equals, it was always the intention of Internorth's management that they would retain control of the organization and run it how they saw fit. This didn't really work out for them. Despite being smaller, Houston Natural Gas was more dynamic in the less regulated gas market, which was something that investors really liked. Their business practices very quickly became widely adopted throughout the entire combined company. In business mergers and acquisitions, the smaller company changing how the bigger company operates after a takeover is often referred to as the tail wagging the dog. There's a lot of dog metaphors in this video. I don't really know why. A quick side note. A lot of people say the same thing happened to Boeing after it merged with McDonnell Douglas during the 1990s. Douglas was by far the smaller company, but their management team took over Boeing from the inside and pushed reckless business practices, which arguably resulted in the tragedies which have been plaguing the company in recent years. Now, apart from being a random interesting fact, there is an important business lesson in this parallel, so remember it for later. But anyway, back at HNG Internorth, the new joint board of the merged company immediately ousted its initial CEO, Sam Segner, even though he was chiefly responsible for executing the merger in the first place. It didn't matter to them though, so he was quickly replaced with the CEO from HNG, Kenneth Lay. Kenneth Lay is often credited as the founder of Enron, which isn't strictly true. In reality, the business wasn't founded, it was just the result of two companies merging to avoid their own individual troubles. Lay did make some big changes though. As soon as he took over, he moved the headquarters from Omaha to Dallas and also set about changing the name. He paid a consulting firm $100,000 to come up with something more creative than HNG Internorth. Lay and the new executive team reportedly wanted a name that would evoke forward-looking technological connotations like enterprise, energy, and on. And if it bore a passing resemblance to Exxon, that wouldn't be a problem either. With that brief, the well-paid creative team eventually came up with a name that will probably sound familiar to you. Yep, that's right. Enron. So that was actually the first suggestion for the new name. Fortunately, before the executive team fully committed to this, a few people pointed out how Enron is the medical terminology for the small and large intestines. Money well spent, chaps, money well spent. Eventually, they just shortened it down to Enron, a name that means pretty much nothing. Now, up until this point, the company, despite having a few close calls, was still just a gas provider with a few other diverse interests in the energy space. However, what these successive business shakeups had done was filter out a lot of the more conservative business leaders and left behind a concentrated group of people who thought they were the smartest men in the room. Adding to that, it became clear how surviving in this business meant managers needed to make big, bold, decisive moves and worry about the consequences later. Now, we all know where that eventually ended up, but the bigger question is, was this really any different from what is happening in the markets right now? Well, it's time to learn how history works, to see how Enron drew the fine line between endlessly overpromising and criminally under-delivering. Today's video is brought to you by Brilliant. Brilliant is a learning app designed to help you actually understand concepts by doing them. With thousands of visual, interactive lessons across math, science, programming, data, and even AI, Brilliant makes learning active, not passive. Lately, I've been spending time in their Programming with Python course. It's a hands-on way to practice writing real code while building intuition for how programmers actually think. You start with the basics, but instead of memorizing, you're solving problems, debugging, and making connections that stick. What I like most is how it keeps me engaged. Each lesson has challenges that build on one another, so you can literally feel yourself leveling up. It doesn't matter if I only have 10 minutes or an hour, it always feels productive. And it's flexible. I can pick up a lesson on my laptop or phone whenever I have time, which makes it easier to keep a daily learning habit going. So if you want to sharpen your problem-solving skills or just get better at coding, Brilliant is a fantastic place to start. To try it out for free, go to brilliant.org/howhistoryworks, scan the QR code on screen or click the link in the description. Brilliant is also giving our viewers 20% off an annual premium subscription, which gets you unlimited daily access to everything they offer. From its creation to its implosion, Enron was only around officially for 22 years, with almost a quarter of that time spent on picking up the pieces of its wreckage. Before 1990, Enron continued to operate its gas and energy businesses to varying degrees of success. But even back during these honest years, the fight to make things look as good as possible was causing cracks. As early as 1987, just 2 years after the company was formed, Enron executives from their oil department covered up losses of more than $100 million. This fraud was later found out in 1993, yet didn't actually impact the company at large too much. However, it was an early warning sign of its developing culture. Failure would not be tolerated. If something wasn't going well, you could either be honest and get fired, or cover it up and enjoy your bonuses. Bonuses which were becoming extremely generous. By the late 1980s, Enron was a hugely attractive company to work for. Their compensation was industry-leading, and their offices were described as palatial. Back then, working for Enron was like working for a top tech company today, only more selective. But this caused problems. If people admitted mistakes or underperformed, then they were looked over for promotions or let go. Then, slowly, one by one, the only people left were those willing to be, let's say, tactically selective with reality. This cancerous corporate culture was turbocharged in 1990 when Ken Lay and other executives at Enron decided that being an energy provider wasn't good enough anymore. Any self-respecting corporate type was getting into the finance game and running their own hedge fund. That was where the money was really at. So Enron hired Jeff Skilling, who at the time was one of the youngest partners ever at the prestigious management consulting firm McKinsey & Company. His job at Enron was to be CEO of Enron Gas Services, a subsidiary of the parent company which was to become a market maker for natural gas and oil. A quick thing you need to understand before you go any further is that these Enron executives loved to make their businesses sound far more complicated than they actually were. This helped to cover up their deception and made them sound smarter than they really were. If they were caught stealing cookies in the middle of the night, these guys would call it moving energy stores out of a concentrated market and realizing consumer demand during underserved operating hours. So, by the same token, the Enron Gas Services business was really just an investment trading firm. Though instead of trading stocks, bonds, or other financial assets, they were trading natural gas between parties that produced it and those who consumed it, all while trying to make a little bit of money as a middleman. To that end, they actually took some of their pipelines offline to customers. So now, instead of just being a pipe that moved natural gas from where it was supplied to where it was burnt, it was going to be used as a conduit to facilitate market movements. To smooth things over with investors, the executive team dubbed their new operation a gas bank. Remember, at this time, finance was the hot industry to be in. Fossil fuels were very 1980s. Now, firms dabbling in markets like this can make a lot of money, but it's by no means guaranteed, and it's also not very consistent. Even the best market makers will make mistakes and lose money from time to time, so you might be able to start to see where this is going. Jeff Skilling, the CEO of the new trading branch also hired one last important character, a banker called Andy Farstow, the final puzzle piece in the Enron conspiracy. Together, these financial boffins created two very powerful tools to make sure that from here on out, all financial results would be good financial results. The first was mark-to-market accounting. Now, the biggest misconception about the story of Enron is that this type of accounting was inherently the problem, which is simply not true. All this system of accounting does is note profits or losses from tradable assets held within an active market value. It is perfectly legal and it's still widely used today. In fact, you probably use mark-to-market accounting more than any other accounting standard. For example, if you invest in the market through an online broker like Robinhood, you will probably see a daily profit or loss noted for your portfolio. That number is marked to market, and all it really means is that if you were to sell your assets today, that is how much profit you would make from when you purchased them. On a larger scale, this is useful for something like a bank or a hedge fund because to report a profit, they would otherwise have to sell their entire portfolio at the end of the year, which obviously isn't reasonable. But the reason why mark-to-market accounting was a problem for Enron was because, unlike a typical financial firm, they were trading things that didn't really have a market apart from the one they were making up. Their new gas bank technically meant that gas contracts could be traded like stocks or bonds. So they took that idea and pushed this accounting system to the absolute extreme. If they signed a contract that could be worth $100 million over 20 years, they would note that as a profit on day one, which would be questionable at the best of times. But then they took it even one step further. If you open up an investment account on a daily basis to nervously check if number go up, you will know that sometimes number do not go up, sometimes number go down. In a mark-to-market system, the accounting team should also mark down asset values as a loss if market transactions suggest that the price has fallen. But again, Enron bred a culture where reporting failure in any way was almost impossible, so they got creative. Ken Lay told Jeff Skilling to make the numbers look good. Jeff Skilling told his new right-hand man, Andy Farstow, to do the same. So he did. Farstow started a series of off-the-books partnerships with nondescript names like LJM1. Enron would then bankroll these partnerships as an investment, but crucially, Farstow would put in a little bit of his own money as well. This technically made these partnerships operationally separate from Enron itself. The way that Enron executives wanted people to think about this is that they were just investing in promising new opportunities. It would be like if a small family business bought some shares in Disney. Sure, they have some money on the line, but they are obviously completely separate operations. Except that in Enron's case, they were not at all separate operations. Enron provided the vast majority of the funding to these shell businesses, and they did exactly what the Enron executives told them to do. And what were they told to do? Well, anytime Enron made a trade, or had a subsidiary that wasn't doing well, these off-the-books companies would come in and buy them up at a massively overinflated price. That way, Enron could report a profit and make their financial statements look good to outside investors. This whole system would be like if you invested $2,000 in an unopened box of Pokemon cards. But, for accounting purposes, you assumed that it contained a mint-condition misprinted shiny Charizard worth $5,000. So, you record a profit of $3,000. $5,000 minus $2,000. However, a year later, when you actually open the pack, you realise that it only contained energy cards and a Blastoise valued at $1,000. Now, in a true mark-to-market system, you should record a loss of $4,000. But if you did that at Enron, you would miss out on your enormous annual bonus, and almost certainly get fired. So instead of owning up to your loss, you invest $9,700 into a new Pokemon card buying business, plus have your friend put in $300 of their own money. That way, it's not technically just your business. This new company then conveniently agrees to buy your subpar card collection for $10,000 by using up all of the cash that was just invested into the business. So now you get to claim that the cards you purchased for $2,000 were sold for $10,000 and therefore netted you a profit of $8,000. at least as far as your disapproving girlfriend is concerned. Now, of course, in reality, you haven't really made any money, you just moved it around. But replace Pokemon cards with overly complicated energy contracts, and disapproving girlfriend with company shareholders, and you end up with exactly what Enron was doing. Clearly, this was dishonest at best. In fact, later on in court, it was proven to be downright fraudulent. So surely regulators would never let something like this happen ever again, right? Well, there is a very similar game being played right now, in private equity. Private companies can also be assigned value using a mark-to-market system. But since their stocks don't trade on public markets every day, their value is only really confirmed once they are sold. Therefore, private equity firms are incentivized to sell the businesses in their portfolio that are doing well and forget about the ones that are doing badly. When strong performers do well, they get to record profits. But if they never sell the duds, they don't have to recognize the losses. The problem with this business strategy is that, over time, if these firms only hold on to their underperformers, they are eventually left holding a portfolio full of garbage. But hopefully by the time they become a problem, the general partner of the firm has already retired. Anyway, back at Enron, things were even worse. They didn't actually have enough cash to give these shell businesses for them to turn around and buy their bad assets. So instead, they gave them shares in the company itself. Since Enron shares always went up, these businesses could use them as collateral to borrow money to buy these assets, which made Enron's profits look good, which made their stock price go up even further. Enron also paid its employees with stock-based bonuses. Its executives made millions of dollars by cashing out their stock, and it also made business acquisitions using its own stock. What you might not expect is how the executives were surprisingly open about how they were reshaping finance. They even held several press interviews all about how their business was reshaping the way markets are built. In a quote to the press, they said, "There's always a lot of focus on technological innovation, but what really drives a lot of progress is when people also figure out how to innovate on the financial model, the financial instruments. I don't think we've figured out yet the final form of what financing looks like." Wait, hang on. Sorry, my bad. That was actually a quote from OpenAI's Sam Altman from last month. I really got to stop getting this stuff mixed up.
Corporate needs you to find the differences between this picture and this picture. They're the same picture.
Anyway, for the Enron execs, the game was pretty simple. As long as their stock value went up forever, their system would survive. And this created an almost singular focus on maximizing short-term stock movements, even if it came at the expense of long-term business fundamentals. This also saw the business start to desperately chase trends that it thought would look good to investors. It had already transitioned from a gas pipeline company into a pseudo-hedge fund. But by the end of the 1990s, it had also gone all in on the internet to keep up with the hype surrounding .com companies. Just like it had laid gas pipelines, it was also laying network cables. Eventually, after this charade collapsed, people started asking questions about the bizarre financial statements the company was producing. One commenter pointed out that Enron seemingly were never able to produce a balance sheet and an income statement at the same time. The stock price tumble was further accelerated by market trends following the .com crash and 9/11. As more and more questions popped up, investors got increasingly nervous, and the lenders who were holding Enron stock as collateral got closer to pulling the plug on the whole game that had been going on behind the scenes. Without that source of cash coming in to massage the numbers, the truth was quickly exposed and the whole business seized up in just 6 weeks. A merger/bailout was considered with another energy company until they actually opened up the books. Once they saw what was going on under the hood, they backed out instantly. On the morning of December 2nd, 2001, Enron filed for Chapter 11 bankruptcy. Just 16 months prior, their stock had been at an all-time high. The financial shell games that the company was built off were so convoluted and technical, it took an outside team of experts more than 5 years to eventually untangle everything and try to pay back all the money that was owed. By the time everything was all said and done, the only assets that the company had which were worth anything were those gas pipelines it had started with 20 years earlier. In a strange turn of fate, Northern Natural Gas, the business that started it all, would actually return to Omaha after none other than Warren Buffett purchased the distressed assets during Enron's liquidation. To this day, they still remain part of Berkshire Hathaway Energy. There weren't many other winners in this story though. Regular employees at the company lost their pensions and most of their savings, since they were encouraged to hold on to their Enron stock as a blue chip investment. It was difficult for most of them to find new employment in the industry, since other companies considered their Enron work experience to be a black mark. And finally, and to be fair, most of the characters from this little show did end up going to prison. But would the same thing happen today? A lot did change after Enron. New laws were introduced to ensure company executives personally sign off and remain liable for published financial statements. Arthur Andersen, the accounting firm that prepared Enron's books, eventually collapsed when it was criminally charged and barred from ever working with public companies again. And lastly, actual, real, genuine protections were put in place to protect whistleblowers coming forward about similar fraudulent activities before they could get this big. It was all great stuff, but in the years since, enforcement of these rules has all but eroded into irrelevance. Now we're starting to see a lot of common themes returning. Creating revenue through corporative deal-making, hyping up new opportunities, chasing the hottest new trend, a focus on stock market performance at the expense of actual business performance, convoluted deal structures, insiders cashing out, mark-to-market accounting that highlights gains and pretends losses don't exist, all held together by people that seem too smart to question. Go and watch this video next to find out how another infamous firm collapsed just 7 years later, if you want any further proof that learning from history only happens when there isn't money to be made from forgetting it. And don't forget to like and subscribe to keep on learning how history works.